Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. November 25th, it's the Friday after Thanksgiving. Short day, and really in terms of the broader markets, kind of a quiet week, which is nice after the year we've had. In terms of volatility, we have seen extreme volatility in both the fixed income and equity markets, and commodity markets as well. But in terms of the equity markets, when I say extreme volatility, I'm really focused on that intraday movement, because the volatility so far this year has primarily been to the downside. But intraday, we've had more 2% moves in the S&P 500 intraday than we have at any other year in the last 50 years. So if you're an investor, a trader, an investment advisor, taking a look at your screens, there's a reason it's been an exhausting year. You know, that kind of volatility takes a toll on you physically and mentally, and we discuss that from time to time. Trying to keep yourself sharp mentally is as important as the research you're doing on where you want to put capital. So in terms of what we're seeing, continuation of what has been working throughout the year. We've seen value, even with this little rebound in the S&P, we've seen value extend some of its relative strength versus growth. So in terms of where we want to position capital and where we're currently positioned, we're going to stay with that trade. And if you look back at our most recent buys in our different portfolios, they've had that value tilt. Now, value's been going on relative strength, winning the relative strength battle versus growth for at least a year now. Will that continue? We don't know the answer to that, but we'll let market action dictate when we need to change. We would expect, if fixed income yields continue to just trend in this area, and if they were to actually start to have further follow through to the downside, that growth, specifically the NASDAQ, could get more of a bid here. In terms of fixed income, fairly quiet week. 10-year all the way down to, let's call it 375. Don't forget, we were talking about a 430, 440 print on that 10-year just 4 or 5 weeks ago. I want to bring up a chart right now just to give some transparency to one of the tools we use to see where we want to allocate capital for clients in terms of a full asset allocation. This is a relative strength chart, and that's a term you hear me use from time to time. So as the market has started to trade a little bit better on the equity side, trade a little bit better on the fixed income side, we keep track on a weekly basis to the buy signals amongst asset classes. And all this chart shows you is what asset classes on a quarterly basis are outperforming each other. The one thing that keeps us somewhat conservative, somewhat defensive on the equity side is the fact that cash continues to be a viable, strong asset class. Even picked up buy signals over the last 3, 4, 5 weeks. Part of that is because of yields. For a decade, cash struggled in the relative strength department because we were being paid less than 1%, often 50 basis points or 1/4% on cash. Today, 3.5. We could look at 1-year treasuries in the 4 range. That makes cash a powerful asset class in our relative strength reading. So we need to recognize that. What we like to do is see what is the current trend in buy signals. And we don't have time on this video to go into what creates a buy signal, asset class versus asset class. But what I can point out is notice in the second strongest longer-term trend, commodities, relative strength-wise, you've seen commodities losing buy signals. So that strength we saw in oil is starting to fade. starting to fade a touch in some of the industrial metals. That may go hand in hand with some of the numbers we look at from an inflation standpoint getting a little damper. Be awfully nice if we could get inflation back in the box. We're going to drop to 2% next month? Absolutely not. Can we start to trend around the recent inflation numbers with a tick down? That would be nice to see. If that happened, we would expect to see that current trend in domestic equities continue higher. Look at the jump internationally. Now, international still is overall a weak asset class, but look at the momentum we're starting to see on the buy signal side internationally. So those are some of the things we try to take a peek at week to week. Where is capital going? What asset class is beginning to show outperformance or even dominance versus another? In terms of that cash position, if we saw any kind of weakness there, we would expect the other asset classes to start picking up more buy signals. So more alternatives to that strong cash position of, let's call it 3.5%, 4% yield. In terms of next week on the fixed income side, some economic reports that may cause some ripples. In terms of equity, we're going to continue to focus on what's working, try to find reasonable levels to allocate. We're somewhere in the cash position. We're somewhere in that, 15 to 20% cash. That's okay. We'll get shots in here. It's served us well throughout the year. It's given us the opportunity to mentally and emotionally look for opportunity instead of being fully invested and worried at every wrinkle. So we'll continue on that path next week. Moose will be back next week with his fixed income report. We hope you had a nice beginning to the holiday season. And next Friday, we'll have a special report on where we're seeing opportunity today. Have a nice weekend.